So what happens next? We're going to find out. Thanks to William Lee, Chief Economist, Milken Institute. Good to see you again, joining us from the City of Angels. We might need some help here because I think a lot of people are very confused. When they first announced the rate hike, people thought, well, that would be the end of the rate hike. So, of course, the markets rallied, yields dropped. Then we had this Q&A session where he meets the press and he's doing the talk, and he tells people like it is, Chairman Powell that is, that, hey, rates are going to stay high for a little longer. And he was a bit more hawkish, if you will. And the markets got just hammered after that, right? Because we didn't get what we wanted to hear. Did he do the right thing?
Well, you know, Phil, markets are like children. They want to hear what they want to hear. And when the parent and Chair Powell says, listen to me, I'm going to be raising rates. I'm going to be raising rates until we see inflation come back down to 2%. Full stop. And the market said, no, 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 no. You guys are going to pivot. You guys are going to ease up. The minute you see unemployment rate or the economy slow down, you're going to quit the game and cave in. And Chair Powell said, no, I'm not. And in fact, today's press conference was to say yet again, hey, stop worrying about how fast I'm going up. Worry more about where I'm going, over 5%, and how long I'm going to stay there, because I'm going to make the interest rate higher than the rate of inflation. Either the rate of inflation comes down to meet me, or I'm going to go chasing it, and I'm going to get above the rate of inflation. That's the story.
That's fine, but why then, if that's the case, William, if that's the case, why doesn't he just come out and say, I'm going to raise the Fed funds rate to 5% and hold it there for 3 months? Why not just come out and say it so the market isn't just guessing?
You know, a lot of us have said exactly that. We should have the Fed communicate how its decision-making is being done. What rules it's following? What are the guidelines it's following? But everyone else has been saying, you know, you shock the markets like that, you raise the 5% from zero, and you're going to blow away the economy, you're going to blow away the markets, and they're not ready for that kind of a shock. So you got to do it gradually. So the Fed tried a gradual approach, and it didn't work. So they started pushing the rate of increase faster and faster. And right now we're at 75 basis points per Fed meeting.
Here's what I have in my notes. Rents are too high in the U.S., or at least the renters would certainly say that, right? Home prices are still too high. The inflation, we can argue whether that's come under control or not. Car prices still too high. Everything is still near the top. What if it doesn't drop back down? What if it just goes up and just stays right there? Is the Fed going to be okay that the prices stay there, or does he need to see prices come down? Because those are two very different things.
Absolutely. And what he said was, I'm going to bring inflation back down to 2%. That means prices continue to go up, but at 2% a year. The Fed doesn't worry that prices are too high. They worry that they're going higher at a faster and faster pace. And that is something where the labor market is going to get into a bunch of the conniptions, because people are saying, my God, not only are prices getting higher, but they're getting higher at a faster and faster pace. So I'm going to demand more wages. Once you kick off that wage price spiral, we're dead, because we're back in the 70s again, and it's game over.
The reaction that I've seen in the markets thus far shows to me that the market does not believe that rates would stay at an elevated level for an extended period of time, because we have you know, not to get too technical here, but we have an inverted yield curve. In other words, the longer you go, the lower the rate it actually is, which means people are betting that rates will come back down again. Do you think, which by the way means recession, but do you think that that is reasonable, that the average investors, that's the mindset that we have to go into, that there will be a recession and rates come back down?
I think most investors and people in general are saying, let's look at history. When we have a cycle of rate hikes, what happens? Once the inflation comes under control, rates come back down again. Where do they come back down to? Somewhere around the rate of inflation. So if inflation goes down to 2%, for sure, rates will go down to 3, maybe 4%. But if inflation stays up at 8%, you can bet your life that rates will go up to 10. So
if I told you, if I said inflation next year will be 5%, let's just say, come Q1 or Q2, inflation's at 5%, and we nail this, we guess it right. Where does that leave the Fed? Are they happy, or did they try to get equilibrium?
If it's at 5%, and we believe it's going to stay at 5%, then the Fed's going to keep the rate about 7. It's going to be above inflation. But if it hits 5% and the year after that, it goes down to 3% and maybe down to 2% the year after that, then the rate will come back down at a faster pace. But the Fed is aiming to keep its rates slightly above inflation. that's where the normalized rates are going to be. And that's always been that way for the history of the United States.
William, if rates really go to 7%, you and I are going to be buying fixed income bonds like it's going out of style. Because why would you do anything else if you can collect 7% literally sitting down watching TV? I can go on about this.
You're too,
William,
you're too young to remember when rates
yeah?
were 14%.
No, I don't want to remember that. I'll take 7. William, good to see you. Thank you, my friend.